Thanks for joining us. This is Eric Douglas and Chris Vaughn with Family Wealth Planning Partners, and we're going to try something a little bit new here for us. So you might have remembered when we used to pretty regularly record our Money Puzzle podcast, and we do plan to start putting this back out on that channel wherever you might listen to podcasts. But we wanted to try something a little bit different because we used to do Burgers and Bourbon.
Bourbon, there it is.
You can tell that it's Friday morning at 9:30 a.m. when we're recording this, and I'm definitely not awake yet. Coffee hasn't kicked in. But we used to do
We have a solution for that coming up, though,
Yeah,
right?
we do, absolutely. So, but we used to do the Burgers and Bourbon video series, and it just kind of fell to the wayside. We weren't really giving it the proper attention that it probably deserved, and as we get bigger and busier and we have to focus on our clients and actually do our jobs, right? It kind of fell to the wayside. So what we wanted to do, and Chris and I are going to try something a little bit new, is we're going to combine the Burgers and Bourbon podcast with our kind of Money Puzzle podcast, right? And we figured we'd do something called the Retirement Happy Hour series, and this will be pretty exclusive to YouTube, I believe. But ultimately, what we want to do is just spend some time chatting with you, our clients and viewers, and going through whatever's happening in the markets, whatever topics that are of interest to us, right? Things that we're talking about with our clients, and all the while that we're discussing it, maybe pull out a nice little bottle of bourbon and enjoy a drink or two while we're talking about it, just to loosen us up maybe a little bit. And who knows where things will go, right? But at the end of the day, we just want to combine a couple of our passions, right? One of our passions, I don't want to say our passion is drinking, right? But we are in Kentucky, so we do enjoy a bourbon from time to time. And, of course, combine that with our love of financial planning and investments. So I will hand it over to you, Chris, because this was your bottle that you brought over, and this is one of the diamonds in the rough. So if we're going to kick off this video series, this is
something good, right?
It's a pretty damn good way to do it. So I'll let you talk about the bourbon, and then we'll start talking about market stuff.
All right. So for those of you who do not recognize this, and we'll throw a picture up there for you, this is Stag. Used to be called Stag Junior. That is not true anymore. They just call it Stag. They have several versions that come out each year. This is 24B, so this one came out last year, mid-year. It is 127.8 proof. So for those of you who like the high proof stuff, you probably are familiar with Stag. For those of you who are not familiar with the high proof stuff, it can have a little bit of heat behind it. But the really, really good high proof bourbons have lots and lots of flavors. So that's a good way to start. While we're sitting here talking,
so it's about to be a good morning.
It's about to be a very good day, right? While we're getting here started, just to introduce you, if you're not a big bourbon person, we've got some water here on the table, and we can put a little bit more water in it to cut it, bring out more flavor, cut it down a little bit. So that's what Eric and I are going to be enjoying while we're talking to you today. And if you're curious why the bottle's about a third empty, this is just something I brought from my personal collection at home, and I've got lots of stuff because I have a passion for collecting bourbon, so we'll be bringing some of my stuff in from time to time.
All right. So along those lines, that's a nice little setup, but let's talk about what we're here to talk about, right? So as we record this, it is Friday, April 11th. If you've been living under a rock, just to give you an idea of what's been happening in the markets the last few weeks, they've been a tad bit volatile, right? Fun in our world for sure to see the ups and downs of the market and what's been going on. A lot of it, a lot of people think that it's being caused by Trump's tariffs, and maybe to some degree that's becoming more true. But let's maybe take a step back. And we'll start talking about market volatility. But first of all, I want to start off talking about kind of the emotional cycle of investing.
All right.
Because we are to the point now where it wasn't happening until really the last couple days. And it really wasn't until we had that big market pop where the market went up about 10% in response to Trump coming out on Wednesday saying that they were going to pause the tariffs.
We're going to do a 90-day pause, right?
Yeah, so we had a market drop. The S&P 500 was down something like 16-17% prior to that, and then it popped up huge in one day because Trump came out. And I was telling clients this, right? Trump's going to come out one day and he's going to tweet something or he's going to make a statement. And it can be something very, very small, something minute, and the market's going to come out and it's going to react very, very positively. And that's exactly what happened. I was actually in a client meeting.
As was I.
And I called my shot, actually, as a matter of fact, before he did it. And I'm in the meeting, and I happened to check my phone and see the stocks, and everything went green in a matter of minutes. And I'm like, okay, I told the client that I was with, I was like, something just happened.
Right.
I don't know what it was, but he came out and said something. But where we're at now when we talk about kind of that emotional cycle of investing, we're definitely creeping into, because the way that it works is when markets are going up, everybody's happy. Everything's going well. It feels good to invest. It feels great. We're in a bull market. That's when it's comfortable. Things are easy, right? So you kind of get that excitement. You get that thrill. You get the euphoria of investing because you're making so much money and everybody's happy and nothing's ever going to go wrong and we're going to have bull markets forever, right? And people forget about all the bad things that have ever happened in the market. We're only going to go up. Then you get a little bit of volatility. You get a little bit anxious, but you remind yourself, okay, well, it's okay. I'll wait it out. I'm a long-term investor. I have a long-term time horizon, right? Well, things continue to go down, maybe a little bit more, and they get a little bit more volatile. So you start to get into denial, right? It's like the stages of grief, somewhat. So you start, it's really not that bad. My portfolios aren't that bad. They'll recover. And then you go into fear. And as you kind of get into fear, that's when the calls start coming in. And quite frankly, we really haven't had very, very many. And I credit that.
No, and we need to talk about why we haven't had that.
Yeah, and we will definitely talk about that because we've been over-communicating a little bit with our clients during this period as well, which is something I think that every advisor should be doing right now. This is quite frankly where we make our money, to be perfectly honest. But as you kind of get into fear and panic, and I don't think we're at panic yet, but I think we're definitely kind of in fear, where people are like, okay, we have a real correction here. We have a really bad market, and I don't know what's going to happen with these tariffs. And this is what clients are telling us anyway. And we'll give our take on that here in just a moment as well. But people are really, really fearful about what's going to happen in the markets because they don't know what's going to happen with tariffs. By the way, neither do we.
Right.
Nobody does, by the way. Anybody that tells you they know what's going to happen, they're full of it. Run away from don't listen to any opinion.
They have no idea what this, but yeah.
But how do you think that? Do you feel like that's kind of where we're at right now as far as what clients are experiencing at this point?
I think it is. I think that probably one of the biggest issues that we have. Let me go back to what you were talking about, that emotional cycle, because you mentioned several of the steps, and we've got a slide we can throw up there for you. I think what people fail to recognize, remember that old concept of buy low, sell high.
Exactly.
Right?
Yeah.
Okay, so when the market is roaring, you were talking about everybody's elated, it feels great, right? Everything's good. That is where your biggest risk is, because you get to a point where it's more likely that it's going to go down than it is that it's going to go up, right? And that's when you're feeling good. That's when you're going, oh, everything's great. And when the market is down, it's the opposite. Now is when you have the greatest opportunity, but that's when people have a tendency to panic. So if you really want to do this right, that emotional cycle, you have to get rid of it.
Well,
if you're emotional, you're almost certainly going to make poor decisions when it comes to purchasing and selling securities. If emotion is in it, you're going to struggle with that.
Well, it's so funny because you talk about buy low, sell high, right? And they made the movie Wall Street in the 80s.
Yep.
This was the whole point. Everybody understands that concept, and everybody knows, absolutely, buy low, sell high. What's ironic is when you start adding emotions into your investments, which is natural because money is emotional to people, right? Their wealth and their savings and their livelihood is dependent upon money and investments, right? So I understand why it's emotional to a lot of people, but it's ironic because it's easiest to buy high is really, really hard to buy low, because when you need to go buy low, the markets usually are in free fall. There's usually some level of uncertainty out there. Nobody knows what's going on. There's been some type of a crash, some type of a correction. Everybody's scared. No one knows what's going to happen next. And so what do you do when you're scared? You stop.
You stop what you're doing and you panic a little bit, right?
Or you don't do anything.
Right.
You freeze. Like a deer in the headlights, right? You freeze and you don't do anything and you wait. And then you wait until the market starts to rebound. And you wait. And once the market starts to rebound, and you maybe give it some more time. Okay, this rally has legs. Now I feel better. Well, you just missed the biggest days in the market, historically speaking. And what just happened on Wednesday of this week when we had that S&P 500 pop, 10% in one day, which is
unbelievable.
Unbelievable. It was the biggest day. It was the best day since October of 2008. That the best single day that we've had in the market since October of 2008. Do we know what a bear market rally is?
Yeah.
Okay. Everyone talks about how bad 2008 was, but people forget that the market did not bottom out until March of 2009.
Right.
So we're talking about this was the best day in the market since October of 2008. All the gains that happened during that day in October of 2008, actually we lost those gains.
Yep,
right?
sure did.
And the market continued to go down after that point. I'm not saying that's what's going to happen here. I don't know what's going to happen here. But the best days in the market, the best returns that you experience in the market typically occur when the market's at its lowest. And when you start seeing those really big gains, those really big jumps, that's usually an indication where, obviously we're not out of volatility. We're not out of the woods volatility-wise, right?
Right.
But usually that's an indication that the market's trying to find a bottom, and no one really knows what's going on. And you see overreactions in both directions, both up and down. And I think that was what we saw this week was an indication that a lot of people want to buy. A lot of people are ready for the market to rebound, and they're really, really scared, and they just got a little tiny piece of good news, and they took it and extrapolated their own emotions onto that piece of news, and they ran with it, and they probably got a little overly emotional on the upside, right? Thinking, okay, we're out of the woods. Just because you're grasping, maybe, I don't want to say you're grasping for hope, but that's probably what it felt like.
That's probably exactly what it is.
Right?
But see, that goes back to that emotional cycle that we were talking about.
Yeah.
If you are investing your own money for a specific purpose, and you're a day trader or you're a professional investor where this is what you do, it's understandable where you can jump around and do these things. But the average person out there is investing primarily for their retirement. And they really shouldn't be looking at the markets this way. This is where you need to be a little bit more steady. And here's another thing, that if you're going to be using that money in the short term, why do you have it invested in something that's really high risk? Okay, so just for fun, I've got the S&P up, which literally, as I uttered that sentence, went from positive to negative and back to positive. That's how volatile it can be, right? But I'm looking at some historical numbers. So the S&P, if you don't know, is the 500 biggest domestically based companies. So it's kind of the benchmark for the overall health of the U.S. economy. All right, if you look at the S&P 500 and you say, oh my gosh, it's horrible. Year to date, it is down 10.25%, right, as of right this minute. All right, but if you look back 2 years, we're up 28.27%. So this is what we've talked about where we tried to educate our clients. Downturns in the market are natural. If you are reacting to them because you look at your portfolio balance and you go, oh my gosh, I've lost all this money. You haven't lost anything. And that's something that I think the emotional investor struggles with. You haven't lost anything. What you have lost is value, but you still own the same number of shares of stocks or bonds or mutual funds or ETFs. Just their value has dropped. So if you'll sit on it because you have time, it'll come back. All you're doing really when you take these occasional downturns, these corrections, is the market is rebalancing itself to its correct value. As emotion comes in and people start buying things up, things become overvalued. Okay, you and I are both big fans of Brian Westbury. And he made the comment this week. We've met him. He's been very pessimistic about what's coming for a long time.
He's the chief economist at First Trust, by the way.
Yes.
He's very, very, very well respected in our industry.
Maybe the most consistently accurate economist.
And there are actually rankings to show that
yes.
he is.
I mean, this guy is the guy that you watch more than anybody else. But he said just this week, after everything had really gone down for a couple of months, but really the last week is where we just took a huge tumble.
Weeks, yeah.
He came out and said, now the S&P is correctly priced, right? Now we've paid the price for the big run up. And if you look at it over the last 2 years, we're up 28.48%. Now, realistically, if we had told you 2 years ago that you're going to invest your money in this, and 2 years from now you're going to be up 28%, you would be overjoyed, right?
Check.
That would be, check that box,
sign me up. Yep.
right? But you got to take the emotional part out of it, because now everybody's going, oh crap, it's going down, I've got to sell, right? No. If you're going to be using that money in the short term, you shouldn't have been invested in the markets like that anyway.
And what's dangerous about the markets is recency bias is a very real thing, right? So whenever the market's up, you think the markets are going to go up forever. When the markets start to go down, you think that the markets are going to go down and they're going to tank forever and there's no end in sight. And the reality is they just adjust. And you talked about the market correcting itself to some degree. By any metric that you look at the market and the way that the market is valued, the market coming into this year was overvalued somewhat severely, quite frankly. And quite frankly, we've been saying this I've been telling clients this for over a year. And I've even had clients that I've talked to in the last couple of weeks like, yeah, you called it. You've been saying it.
Yep.
I didn't know.
And let me insert, one of the primary reasons why it was so overvalued is what we've been calling the Mag 7.
Yes.
So talk about the Mag 7 and why that's an issue.
So the market has been overvalued specifically because when you look at the Magnificent 7 stocks, these are the biggest stocks that are in the S&P 500. These are your Amazons, your Apples, Teslas, Microsoft, NVIDIA, Google, Facebook.
Yes.
Right? So I think that's
or
right?
Alphabet and Meta to be very precise,
exactly,
right?
Yeah, right. But basically the 7 biggest stocks. And when you look back at the returns of the last couple of years, because the S&P 500 is what's called cap weighted, market capitalization weighted. So it's not like they're all equally. It's not like you have 500 stocks in the S&P 500 and they all have the same weighting. The biggest stocks have a bigger weighting relative to the overall portfolio.
Right.
So when you combine the market capitalization of those 7 biggest stocks, it had gotten to the point coming into 2024 where it represented about 43%, I believe, of the S&P 500. Just those 7 stocks.
Out of 500.
Exactly. So you had 493 stocks that represented only, less than 60% of the index. Does that sound like a diverse portfolio?
No.
No, it is not. And it's amazing how people think, well, I own 500 stocks because I own the S&P 500. I own a diversified portfolio. No, you do not.
Not really.
you do not. Not to say that the S&P 500 is bad. We just need to know what it is,
right, and
how it's weighted and how it's priced. So because those Magnificent 7 stocks, and a lot of it has to do, you can say, it's based on, COVID stimulus money. Everybody was working from home. These are primarily tech companies moving into, over the last few years, there's been a boom in AI investment, right? Been a lot of talk about AI and where that's leading. And these are the companies that are leading the investment into AI technology. So there's been, pricing in gains and future potential gains because, we're viewing all these companies as technology and AI companies. And there's something to that, by the way. However, any metric that you looked at, price to earnings and, book value and, sales ratios and all these different things that we use and that the market uses to price or put values on companies, every single one of these companies was overvalued relative to their stock price.
Right.
So at some point there was going to be a correction, and we knew coming into this year, and I've been saying it's been overdue for probably about a year.
For a while, right.
So we've been saying it for about a year, and one thing about the markets is they can be irrational for a lot longer than you want them to be, both on the up and the downside. So, and this is going back to what you were talking about, Brian Wesbury was saying, well, the market's probably more correctly priced right now. That doesn't automatically mean we're going to get a bump. We can still continue to slide down.
Yep, that's right.
Because there's fear, right? And people are maybe starting to panic. We don't know what's going to happen with the tariffs. So the market can reprice itself, and then it can become undervalued. And then it becomes an even better buying opportunity. But coming into this year, we knew that the market was overvalued, specifically on the very high end of the market with those Magnificent 7 stocks. Growth sector, tech sector, et cetera, right? So, we had actually adjusted our portfolios accordingly, and we had devalued or lowered our exposure to some of those sectors, specifically at the beginning of the year. So we actually were pretty well prepared. But all that to say, there was a correction a-coming this year. It didn't before anyone knew what a tariff was a few weeks ago.
that might have been a great segue because I wanted to go into that conversation.
Yeah, and we'll talk about tariffs. But before anyone knew what a tariff was a few weeks ago, there was going to be a correction. We got it. We just needed the catalyst because the market has to react to something. The market isn't going to say, oh, NVIDIA is overvalued, everybody sell. That's not the way that this works.
No, it doesn't work that way.
People need a reason to sell, right? People need a reason to make a change.
They need a catalyst.
Exactly. They needed a catalyst, and the catalyst became
all
Trump.
The tariffs. That's right.
Yeah, and Trump is getting a lot of the blame for what's happened in the market. Now, we can debate that in a minute.
Okay, so if I may, I have had this conversation with several people where they've talked about the tariffs are causing the markets to go down. No, I disagree with that. The tariffs were the catalyst
Correct.
to kind of light that bomb that we all knew was coming. Now, the issue is, are the tariffs going to continue to push the markets? Are they now going to be the driver instead of the catalyst? And that's what we all, quite frankly, we don't know right now.
And I think that's where we're at right now, because we got our correction. The correction is basically what a correction is, just to make sure everyone's on the same page. A correction is a drop of over 10% in the markets.
From their most recent high,
from
right?
Their most recent highs. So we've gotten a correction and some. So we are probably pretty relatively correctly priced. I would assume if the markets continue to go down from here or maintain volatility in the near future, that's not because of the market being overvalued at this point. So now I think we're into fear and uncertainty, going back to that emotional cycle of investing. Anything that happens in the market at this point going forward is based upon what people think is going to happen. And the unfortunate reality is we're not going to know how these tariffs are going to have any effect on the market until probably the end of summer.
Yeah, that's probably true, because it takes time for everything to flow through the economic channels.
Well, so we're sitting here at the beginning of April, which means it's the beginning of the second quarter, the very beginning of the second quarter. We're going to start getting earnings reports, by the way, from all of these companies for the first quarter. And a lot of these companies are going to have really good earnings reports looking backwards.
Yeah.
But what's going to be very, very interesting is the forward guidance that we see from a lot of these companies, from a lot of these companies that are reporting their earnings from Q1. Because, we had a heck of a quarter, but that's in the past. That doesn't mean anything going forward. Everyone's going to want to know how these companies view tariffs and how they're going to affect their balance sheet, right? And so it's going to be really interesting what type of forward guidance estimates that we see, and if we have estimates that are revised downward. So if we see a lot of companies come out in their earnings calls over the next few weeks, and they start putting out downward guidance because they're afraid of what's going to happen, and quite frankly, you can probably expect that. Have you ever heard of the term under promise, over deliver?
Yeah, that's right.
So you have public companies that have the ability to reset expectations on the idea that they can overperform down the line and get a pop in their stock price later on down the line because they're going to beat earnings. Because all these public companies want to do is beat earnings, right? At the end of the day, that's what their goal. They always want to beat expectations. Yeah. Well, right now they've been given on a golden platter an opportunity to lower expectations. And public companies, they don't like to do that, right? They don't like to lower expectations because that affects their stock price.
That's right.
But now they've been given an opportunity, so you're going to hear a lot about this. These companies think that the market's going to crash, and they think that tariffs are going to end the economy, and that everything's horrible, and everything's going to come to an end, and that's going to probably create more fear and more uncertainty, and it becomes a domino effect. So it's going to be really interesting to what degree these companies think tariffs are going to individually affect each one of these companies. Right. And I don't know. Nobody knows.
Well, I think that's so. Let's go into the tariff conversation a little bit. I think probably the biggest issue with the tariffs, it's not that the tariffs are good or bad. It's that we don't really know what Trump's end game is here. So whether you like him or hate him, or I don't care. When you don't really know what he's up to, that's where you get the volatility. So, for example, if the Trump administration communicated very clearly that we are going to put tariffs on everybody, for example, but when those countries come to the table and we renegotiate the way things are going to go between those two countries, and the goal is to get down to zero tariff both directions, that if we knew that was the end game, the market would spike. If we knew that. That's why when you had the postponement, the 90-day postponement on 75 countries or whatever, that's the reason the market spiked, because they saw that opportunity coming up. Back to your point, as these companies are starting to look at their earnings forecast, China becomes a big issue, because in the middle of all this, we said, or the Trump administration said, okay, we're going to pause on everybody else except for China, because they weren't nice. We're going to double down on them.
Talking about being emotional.
Yeah, we're going to put a 125% tariff on top of the 20 that we were already doing. So it's now a 145% tariff. Okay, fine. Let's punish China. They manipulate their currency. They're taking advantage. Okay, I'm all for that.
Patents and
how much of the products that we buy are made in China? Okay, let's just look at the table right here. All right, the glassware and the whiskey, thank God the whiskey's from Kentucky, right? From a distillery that's currently underwater. Oh my gosh, yeah, Buffalo Trace is underwater, right?
Yeah.
On the other hand, the devices that we're using right here, good chance the microphones, everything else, these are probably products that are made at least in part in China. Right? How does it impact that part of the industry?
Apple specifically.
Yes, exactly.
I mean, they're very heavily entwined into the Chinese economy. So
right.
this iPad, that iPad, our iPhones, which are recording us right now.
Yep, exactly.
Those came from China.
So how does the tariff on China, which in my personal opinion, that's going to be a little bit longer lasting. I do not think, I don't care whether you love Trump or not. You and I have had our discussions and we disagree on some things and we agree on others about him. But I think he's very pragmatic. And I think when he sees things going poorly, he changes his course because he wants to win. That's what really drives him. Okay. Mm-hmm. So I think long term, probably this year, most of this tariff conversation settles itself, right? Sure. Negotiations don't take place in a week. You know, when we hear on the news, oh, so-and-so is flying in right now, and we're going to fix this. That does not happen in an afternoon, right? This can take months or years for these negotiations to work out. I think the pressure will be relieved as we see that we're trying to do that. I don't think that's true with China. I think this is going to be a little bit more of a long-term thing, and that's where I'm concerned. And all these companies that make up the S&P and the Dow and the NASDAQ and all these other types of investments that we use, those companies are all going to be impacted by that trade with China. So that's where I'm kind of looking at, we're going to be looking at a lot of volatility. While we've been sitting here talking, I made the comment that the S&P 500 went green, went back to red, went green again, or maybe I said it backwards. It is now down 0.71% today, and that has happened while you were sitting here talking and kind of walking through what's going on in the markets. So that's where
I think
that
if we stop talking.
You know what? Then I'm going to shut up if that happens. But also, how's the Fed going to what changes are they going to make? We just saw a report come in. I was reading this morning that. I don't know if we just had a mistake happen there or not. We had a report come in this morning that said that the inflation numbers came in lower than expected. They were expecting 2.6, and what we got was 2.4. Okay, well, 0.2% doesn't sound like a whole lot, but when you're looking at it on a macroeconomic level, that's a big number. So what does the Fed do? How does that affect the markets?
Yeah, and the Fed hasn't really made any policy changes at this point, so we'll
right.
see if they do come in and intervene, which, that's always a mixed bag, and there's, you never know what's going to happen or what decisions that
right.
they decide to make. And, we've all had issues with the Federal Reserve coming in and making trades, but one thing I think we can all agree on is if this were to be sorted out by the free markets, it would be done a lot more efficiently and a lot more quickly than if the Fed intervenes.
Hallelujah.
So hopefully they take a step back and just kind of keep their paws off of things and try not to fix. I'm going to use air quotes here for anyone listening
right.
and not watching, right?
So for those of you that are watching and or listening and don't know this, Eric and I are both very much free market people. Turn it loose and let it do its job, and everything always works out to the right answer. So when we're talking about free markets, that ultimately is the answer. But politics are never going to allow that to happen.
Yeah, but I do want to elaborate on one thing because you talked about the messaging.
Yeah.
So quite frankly, most of what's occurred right now is not occurring because of the T word, tariffs.
Right.
And that's what's getting all the headlines, and everybody's freaking out about tariffs. I sent out an email to our clients earlier this week, or I guess it was last week when we started to see some of the volatility, but giving some charts and some data around market reaction to tariffs. The long story short of it, tariffs in and of themselves have very little effect on the stock market.
Yep.
The tariffs themselves do not have much of an effect on the economy either. I mean, it doesn't really affect much of what's done and the free market, if you will.
Right.
The free market is not overly affected by tariffs themselves. So tariffs themselves are not in and of themselves good or bad. They just are. They are a tool to enact trade policy. Mm-hmm. Okay. The market volatility over the last few weeks has been in direct response to the messaging, or maybe we should say the lack of messaging.
The lack of messaging. There it is.
And this is where my issue has really come in. And this is where, I don't want to get too terribly political, but
Go for it, man.
This is where the issue, has lied. It's not in the tariffs themselves, it's in the messaging, because we don't know, are we trying to bring back, are we trying to increase tax revenue, or are we trying to renegotiate trade deals? Because you can't have them both.
Right.
At the end of the day, you can't have one. You can't have them both simultaneously. If you're trying to renegotiate trade deals, okay, that's great. That's an outcome in and of itself. But if you're renegotiating trade deals, you're probably not going to increase tax revenue. If you're trying to use tariffs specifically as a means to increase tax revenue, then you're going to leave tariffs alone, and you're going to leave those tariffs at a higher level to increase the revenue coming in because of the tariffs. And you're not as worried about the trade negotiation part of it, right? So those two things are in conflict with one another. And so, you have one Trump administration official coming out talking about we're going to increase tax revenue, and then you have Trump himself coming out and saying we're going to, art of the deal, right? And so we're getting mixed messages. And when there's uncertainty in the markets, and everybody knows this, and we talk about it all the time, whenever there's any level of uncertainty in the market, that's what creates this high level of volatility. When we don't know, when we can't predict the future, the market reacts accordingly.
I think so. Let's go back and talk about some basic philosophies from Warren Buffett for a minute, and then I want to stop and talk about this whiskey for a minute because this is outstanding. But anyway,
yes,
if you think about Warren Buffett, so Warren, greatest investor of all time, but one of the things that he teaches is that if you're looking at an individual stock, what you're looking at is a company. That company has management, they have a board of directors. All of these people are working to make that company better. It's a very intellectual exercise, right? So when you look at buying a stock of an individual company, you can predict what that company is going to do, right? But when you're looking at the markets, it is an inverted equation. It is a 100% emotional equation. So when you look at the S&P 500 or the NASDAQ or the Dow, and you're looking at multiple companies, right, it is a completely emotional thing. Now, for those of people who are saying, well, Trump is causing all of this, right? Everything was better with the last administration, blah, 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 blah. Okay.
There's probably a lot you can add to that blah,
I
blah,
can
blah,
add a whole lot. We could do a
won't.
2-day podcast on that one thing. Here's what the markets as a whole say. Do we know what the rules are? Do we know the rules with which we have to play? If they do, the markets are usually positive, right? They don't care that they like the rules or dislike the rules. They know what the rules are. They know what the current political environment is, right? On the other hand, when they don't really know what's going to happen, and that I think goes back to that messaging part. We don't know. Is this a play to try to even the playing field? Is this, as Trump has said, this is permanent. I am not taking these off, he said. And I get that is probably part of his art of the deal thing. But when the markets don't know what's going to happen, the markets go sideways. You made the best comment the other day. We were talking about this. You said the markets are drunk. Yeah. Their behavior was if they were drunk. Mm-hmm. And that is because the markets as a whole are emotional. And right now, we don't know what the rules are. The rules are going to change day by day by day. So that's kind of the point that I would look at when we're talking about emotional investing with the tariffs that are going on, all those other things. What it comes down to is the markets are emotional, and that's why they are reacting the way they are right now.
And I think, and I think I will even add one thing, and I'm definitely not going to go into the weeds on the bond market.
Oh, that's a whole different can of worms right there.
If I want to lose a lot of viewers, that's one way to do it, to start talking about bonds. But there's a reason that Trump came out on Wednesday specifically and did the press conference and said that he was going to put the pause on tariffs for 90 days. And that was in direct response to the 10-year Treasury going up. The reason the 10-year Treasury was going up was because countries were selling their treasuries. And for those that don't understand, U.S. Treasuries, that's your debt.
That's the U.S. debt. That's exactly what it is, right?
And so companies that held U.S. Treasuries or bonds, right, they were selling their bonds and getting their money back. So the way that a bond works is, let's say Japan is out there and they decide that they're going to buy U.S. Treasuries. So they send the U.S. Treasury X amount of dollars. And in return, the U.S. government is going to pay them a certain amount of interest depending upon the whatever terms that they agree to, right? And they're going to pay them out a certain amount of interest over a certain amount of time. Well, when other countries start selling their U.S. Treasuries, that's basically forcing the U.S. economy or the U.S. government to pay that money, and they're losing the ability to keep that money in-house to fund the operations of the government. So what was happening was other countries were calling in their U.S. debt, basically.
That's right.
And once that started happening, what was happening, Trump didn't come out and make the statements he did. He didn't change his policy. He didn't change direction because the stock market was volatile. The stock market is supposed to be volatile, by the way. That's a feature,
that's
not
a
a
normal
bug.
Thing, right?
That's a very normal thing, and you need it to be normal. That's how you get the returns over time, is with the volatility and with the risk. The problem was in the bond market, and he was trying to stave off any type of panic in the bond market because that's a far bigger deal.
Yeah.
And we talk about 2022, and it's interesting how much attention has been paid to what's happened this year in 2025. 2022 was a horrible, horrible year in the markets, and I felt like it was very muted. We can debate why, maybe, depending upon, the going back to your blah, blah, blah and the previous administration, right? But the fact of the matter is 2022 was a really bad year in the markets, but it wasn't because the stock market was volatile. The S&P 500 at one point bottomed out about 25% before it rebounded a little bit at the end of the year. The NASDAQ was down even more than that. The Mag 7 actually took a pretty big beating in 2022. But the problem with 2022 was the bond market, because you had fixed income portfolios that were down 13, 15%. Because, once again, this is going back to what I was just talking about. There's an inverse relationship between rates and price. So if interest rates go up, price or value of bonds goes down.
Goes down, right.
That's what happened. Federal Reserve was coming in, raising interest rates to combat inflation. And so you saw the value of bonds plummet. And so what was supposed to be the safe haven of a retirement portfolio, everyone talks about the 60-40 portfolio, and we've talked about how that 60-40 portfolio is dead ad nauseum, right? We've talked about that plenty, or at least the way that it used to be implemented is dead. The concept is still very well alive. But that was the issue. The 40 of that 60-40 was down just as much as the 60 in some cases. And so that was a huge, huge problem in 2022. That had not happened this year. This year, bonds were holding up their end of the bargain. The fixed income market was doing pretty well. Once there started to get a little bit of volatility in the fixed income market, that was when Trump came out and gave his statement. It wasn't because of the stock market volatility, and I've heard a lot of people suggest that, the market was crashing. It had nothing to do with the stock market. He even said so in his presser. It didn't get that much press. And a lot of people probably don't really understand
I think that's
the
because
bond
the
market.
press doesn't understand the bond markets.
Yeah,
they don't know how to report something they don't understand.
But yeah, he came out and he talked about the bond market and he talked about treasuries as kind of the somewhat specific reason why he came out and did what he did, because he was trying to stave off basically a run on the U.S. government debt and forcing us to basically have to pay on our government debt, because no one wants to do that, right? So that was a huge, huge issue. But let's talk about our bourbon.
Wow, there's a transition. Okay, we'll kind of wrap up that conversation. Before we switch into the bourbon, I would suggest, if you are invested for a long term, then watching the trend line that I'm watching right now, which during our conversation it looks like a heartbeat chart. It's up and down and up and down and up and down. But if you look at it over time, 2 years or more, it's all green, because it goes back to that example we talk about the mountain climber going up the mountain. But he's doing a yo-yo. Don't watch the yo-yo, watch the mountain climber. If you have a short-term format, let's call it under 10 years that you're going to use this money, why would you be invested in this way in the first place? That's just not wise. So, all right, so let's go on to talk about it. What do you think about the Stag 24B?
Well, for as strong as it is, what is it, 120?
127.8, I think we said.
127 proof.
Yeah.
Was this this is barrel proof. Yeah. I don't even think I realized that. You got to barrel proof.
All Stag is like that.
No, it's actually really smooth for 127.
It's really not that what some people would call hot. And if you saw me while you were sitting there talking, I actually put just a few drops of water in it just to see what it would do.
Yeah, I haven't done that. So.
Beforehand, what I tasted was cinnamon and butter. I mean, it was just like butter. It was wonderful. Then I put a few drops of water in it. And by the way, I didn't think it was that hot. The proof did not, burn me or anything. Now, I have a palate that's used to it, but when I put a few drops of water in there, I don't know, 3 or 4, the butter changed to honey. But the honey was spicy.
I just tasted that.
Yeah, it actually got hotter when I cut it down a little bit with water. That was what I tasted. And by the way, they were both outstanding, but I preferred it before I put the water in it. And if it was a little bit later in the day, I would probably have a little bit more bourbon in the glass just to get it back to where it was, because that was awfully good.
Yeah, like I said, Friday morning, this is probably not the ideal time to be drinking bourbon, but we...
You got to record when you have time to record, right?
This is when we have time, and, so my next couple client meetings this afternoon could be fun. But,
no more client meetings for me today.
I'm not anywhere near that. I'm totally fine, right?
Yeah.
But yeah, I 100% great bourbon, great conversation. The one thing I'll add, and we can go ahead and probably start wrapping things up.
Yeah, let's wrap it up.
But I will say, this is probably a good way to wrap it up. Send out an email, over communicating, right? So I've been sending out mass emails to our clients over the last couple of weeks, and maybe a couple of them are sick of hearing from me, but I don't really care because this is when we need. I
haven't had any complaints from over communication yet.
No, I have not either. Yeah, but definitely. Actually, I've gotten quite a few really positive responses.
Mm-hmm.
One of the responses I got really stuck with me. This individual, he retired 2 years ago. Been working with him, set his portfolio up. And, he's taking distributions from his portfolio, and he's doing all the things in retirement. He's, done some renovations to his house, and he's living life, and he's doing great. Sent out an email, and he responded, said, yeah, you know what, I am actually really afraid. It's hard not to be afraid when you watch the news media. It's hard not to be afraid because everything in the media is bad, and everything is going to, if it bleeds, it leads. And the financial news media is no different.
No different. That's right.
And so he said, yeah, it's really hard to be difficult, or it's really difficult to avoid the news and to not be somewhat afraid. But, I trust you, and I trust what we're doing, and I'm really not that worried. So I responded, and I gave him a call and just said, by the way, got your response. I just wanted to do a quick review with you over the phone just to maybe quell any concerns that you might possibly have. Pulled up his accounts. I said, the way that we constructed your portfolio, where your income is coming from over the next 10 years is not invested in the stock market.
It's not affected by this.
All the money that you need for the next 10 years hasn't gone down a dime. Hasn't lost any value. Actually, it's making money right now. We're generating income on it. It's still making money right now. Hasn't been exposed to any of the stock market volatility whatsoever. And then I gave him the numbers, and I said, and that's X% of your portfolio. So X% of your portfolio, there's no downside.
Right.
So yes, this portion of your portfolio, and I gave them the numbers. I said this portion of your portfolio is down whatever it was at the time. It wasn't even down as much as the market because of the way that we manage our portfolio's. We went defensive earlier this year, and I'm not going to get into those details right now.
That's another podcast right there.
But we were actually pretty well prepared for this downturn, and so he wasn't even fully exposed that way either, even on the equity side where he is still fully invested. So we ran through some numbers, and he's like, "Oh, okay." And I gave him the overall number, and it was like, I think his overall portfolio, mainly because of the equity side only, really, was only down 2-3%. He's like, "Oh, that's it? Yeah, you're not exposed.
That's the design.
You're not exposed. Yeah. The amount of risk in your portfolio is relative to when you need the income." So once I gave him that number, he was very much at ease. I was like, "Oh, I made his day." Like, "Oh, that's it? I'm only down a couple percentage points? Okay, yeah, I'm fine." Because according to the numbers that he's seeing on TV, how everything's doom and gloom and the market's crashing and everything's going to, the end of the world's near, right? And this time is different. God, if there's a phrase I'm already sick of hearing, this time is different. No, it's not.
No.
It's not different. It's not. If it is different, actually this time is better. If you want to compare this to 2008 or 2001 with the dot-com crash, I'll take this year over those two other. Those two were far worse because systematically something in the economy broke. That has not happened yet. Not to say that it won't, but it's systematically something in the economy broke. That has not happened yet. Not to say that it won't, but it's systematically something in the economy broke. That has not happened yet. Not to say that it won't, but it's systematically something in the economy broke. That has not happened yet. Not to say that it won't, But right now, nothing in the economy has broke. Everything is based on fear and uncertainty, okay? If something breaks, then we'll reevaluate, and we'll probably do another podcast, and we'll have another bottle of bourbon, and we'll talk
Something
about
different
it, right?
next time.
But right now, nothing has really fundamentally changed or broken. The tariffs just went into effect, I think, yesterday, maybe. And those are the ones that are still in effect, and I think it's only on China, right?
It's only on China, and then I think it's a 10% across the board until negotiations go.
So, and most of those are going to change so much over the next few weeks. But all that to say, that individual, that client that I was working with, his fears were so, they weren't that bad, right? He wasn't that fearful. But once we had a conversation and just reminded him of the things that we put in place and why we put them in place for years like this year, for the things that are happening today, he was great. He was wonderful. Went on his day. He doesn't care. He does not care. He is not exposed to this stuff. He's not worrying about these things in retirement.
That's the difference between investing and planning.
Exactly. Yes.
That really is the difference right there. It's you don't own the markets. The media is reporting on what will make people watch or read, and most importantly, buy the advertising that's on their space.
And it's also, and I'm going to throw this out too. We haven't talked politics too terribly much, and maybe that's another drink or two, before we start doing that. But be careful where you get your news from in times like this.
Yes, agreed.
And this is, we're right of center. That's pretty clear. Anybody that knows me knows that. Although if you know me, you know probably the party I hate more than the Democrats is the Republicans, even though I vote for Republicans more often than not. But you need to be really careful where you're getting your news from. And if you're getting your economic news from a political source, do not trust a word that they say.
Absolutely.
Do not trust a word that they say. Because I listen to the same news programs. I hear the same stuff, right? They do not know what they are talking about, both left and right. Do not get your economic news from a political source, because everything that comes out of their mouth is going to have a political bent to it. Drives me nuts listening to people on the right now that were railing against Biden in 2022 when the market was dropping. Now support what Trump is doing, and it's just money. It'll come back. You can't have it
Pick
both
one.
ways. You can't have it both
you can't.
ways. Okay? And I'm picking on my own side right now, but I could do the exact same thing on the left.
Yep.
When the left was justifying everything that was happening in 2022, okay, and now they're using this as an opportunity to bash Trump, okay? The market is what it is. It's going to do what it's going to do. You would be amazed how little politics has to do with the economy and how little it has to do with the performance of the stock market, okay? Do not get your economic news from a political source. I don't care what side of the aisle that you're on. Talk to us, vet your news sources.
There you go.
A little bit more carefully.
Yeah.
Make sure you're getting a little bit more of a comprehensive review or what's the word? Nonpartisan.
Best you can. It's really hard to completely tune all of the politics out. They are intertwined to a great extent, but that's great advice.
At least understand who it is you're listening to.
Most news sources have a political bent.
Yeah.
You know what I mean? And so you got to be very, very cautious on what you're actually believing. So let's wrap this up.
Great bourbon, great conversation.
Do something different next time.
We'll do it again.
All right.